Hello, everyone. Hope you're all doing good. This is Ibrahim. I'm a relationship manager in SmartFX. And today we are going to be learning about live account. We discuss almost every other topic on different days of the week. On Monday and on Monday I teach in Hindi, and on Wednesday I teach in English. So if you're new here, you can register on our platform and you can sign up with all of these social media platforms to get to know more about us. And if ever you feel that you have a query or you have any question, you can text me on this number. I'm always available to be able to help you. Okay, so let's get started with live account. Now, when you talk about Forex, okay, Forex is a very big thing, but not since the beginning. In the beginning, only Forex was barter system. Okay, people used to trade stuff for other stuff, like giving three cows for maybe milk, rice, and stuff like that. And this was the condition of Forex before. Forex has been in this market for very long time, but then again, people didn't know how to trade, when to trade, and who could trade. When you talk about Forex in the late 90s, people could only trade if they were a millionaire or a billionaire. Only the rich could trade. No poor people could trade at that time. Okay. And even if you check the trading past, what has happened, you would be able to check that mostly people who traded were trading in small lot size. Okay. Not big as well. People would buy stocks. They would call a broker that please make this as a buy over here. And the trader would then, send a fax or something to the exchange. The exchange would buy it for them. Okay. So that is how global market was at the beginning. The surge in their popularity, where did it come from? It came from events where people could be at home and they could be earning. For example, if you take COVID, what happened during COVID is that people lost their jobs, most of them sat back at home, wanted to, earn from different opportunities in the market. What did they do? They saw that they could earn online. How? Through Forex trading. So popularity mainly rose when there was COVID, okay? And that's where mainly people tried to earn money through Forex market. Now, when we discuss global market, what does it include? There's a lot of stuff, but mainly we are looking at foreign exchange, means currencies worldwide, whichever currency is there, there's a currency pair. You'll be trading on them, buying and selling. Then comes global indexes or indices, which is a group of companies. So if you're checking any groups like US 30, S&P 500, Nasdaq, those are the groups of individual stocks. Indices, again, mainly people why they like is because even if a company fails, let's say out of 30 companies, one company fails, the rest 29 companies are still there to support the average. Since you're trading on the average of these companies, 30 companies, if even 29, I mean, one of them fails, the other 29 are still there to support you. Okay. Then comes commodities, which is gold, silver, crude oil, which can be traded raw. Okay. That's what mainly people are looking for during the time of wars and everything. Then comes future contracts, treasury bonds, index future, etc. Future contracts means you're predicting the price in the future and then you are trading on that. Okay. Future contracts will be given by obviously the broker itself or US exchange. But then again, you can trade on the basis of what can happen in the future. Okay. These products are often traded over the counter, hmm, which is mainly people just do it over the counter. But CFD is the strongest way to deal with currencies and other commodities. When you take CFD, people mainly mistaken it for OTC, but it is actually CFD, which is spot trading. You are trading on the market price, which is happening right now. Following the pandemic, global markets are increasing in popularity due to what are the reasons? Again, we'll check. Flexibility of trading hours. Now you have the 24/7 instruments, some of them, and most of them are 24/5. which, like, on Saturday and Sunday they are closed. So you have the flexibility of trading, okay, ability to exploit opportunities from both rising and falling market. Since this is a CFD market, you can make profit from both buying or selling opportunities. Okay. Lower capital requirement for most instruments. You don't even need to have thousands of dollars. You can have a small fund through which you can start trading through leverage. Again, leverage is a very big term. It has a lot of pros and cons. So please go through what is leverage and then only try leverage. Okay. Better liquidity compared to equity and share market. In a day, there's around 7 trillion transactions in Forex. So you can imagine the liquidity is so good, because liquidity basically means when you buy something, there should be a seller on the opposite side immediately. Or if you're selling something, there should be a buyer on the other side, buying on the same price. Okay. So that is known as liquidity, leading to faster execution speed. You wouldn't have to wait. Like sometimes what happens is someone buys, and then if there is no liquidity, he has to wait for the person to buy or sell at that price. Okay. Then comes insider trading. Insider trading is basically a way of manipulating the market. Insider trading can be done through, like, knowledge of the market or knowledge what the CEO is doing, what he's planning to do in the future. That is called insider trading. Market manipulation is kept to a minimum, means it's not done so much considering the scale of the market globally. The scale of the market globally is so huge that insider trading and market manipulation can make a very less difference in the market. Okay. Forex is short form for foreign exchange, largest and most liquid market in the world. In 2008, 2009, the transactions daily were 1.9 trillion US dollar. Today, the estimated transaction is more than 7 trillion. I should update this because this is 6 trillion. It is more than 7 trillion, more than 100 times the largest and most traded stock market in the world than NYC. NYSE. Okay. So foreign exchange market consists of a lot of things like physical transactions, digital transactions without leverage through bank transfer, physical currency, currency options, and Forex CFD. Means there are so many payment options right now that people can do any kind of exchange. What is referred by most traders in Forex market are the CFD based transactions. If you are a Forex trader, you would mainly go for CFD based transactions. SmartFX, the company I work for, are offering most currency pairs that are commonly traded with leverage through CFDs. If you would like to trade in currencies, you can do it through CFD and leverage. Okay. When you talk about commodities, commodities are of two types. I'll explain that later, but first let's understand what is commodity. Commodity market refers to a market where primary and raw products are traded. Means whatever is traded over here is actually traded physically also. Okay. So when you say hard commodity means gold, silver, copper, because their prices are mostly affected by manufacturing data. If there is more mining, if there is more supply and less demand, if there is more demand and less supply, differences can occur, and that's the main thing which will change the price. Then comes soft commodity, which means wheat, cotton, coffee. In these times, what usually happens is that when you're trading these, prices of this will be affected by seasonal changes. Means in some seasons, maybe the wheat and coffee will be in more demand than cotton. And sometimes maybe in the month of December or something, cotton will be in more demand. And that's how prices get affected in soft commodity. SmartFX basically offers US oil, UK oil, gold, silver for clients to trade through CFDs. Then comes equity index. Equity index, like I told you, it is a benchmark index, weighted average of top stocks listed. Means you have to check which are the top stocks in a company, and you have to trade on an average of that. Let's take example of US 30. What is US 30? It is a index. In an index, you have different companies like Microsoft, let's say Apple, Tesla, and other companies. What you're doing is you're trading on an average of those companies. So what this does is that it keeps you a bit safer, on the safer side. When the market crashes, it, it does not crash so easily because there are so many companies in that weighted average. Okay. Most of them prefer to use index instead of stocks because index provides much more security than a stock direct. Okay. Every country has their own index but are not openly accessible. Some of them have their index worldwide, globally traded. Some of them only give an option to trade if they are of their own country. Trading in index is generally easier, like I said, for traders compared to trading individual shares. Because if you try for individual share, if the company goes in a loss directly, your portfolio will be very much down. In index, what happens is there's 30, 100, 200 companies altogether. The portfolio won't be much affected. Okay. SmartFX offers major indexes like Dow Jones, Nasdaq, ASX 200, and Nikkei 225. Let's see the advantage of CFD instrument. CFD stands for contract for differences. Means even if you buy, the market goes up, you get profit. If the market goes down, you get a loss. If you sell, if the market goes down, you get profit. If the market goes up, you get loss. This is the simple CFD instrument. Okay. So 24 hours market is open for CFD instruments. 24/5 though. Okay. Traders can choose their own trading hours. You can trade at any given point. Okay. Except Saturday and Sunday. Traders can have their own trading style. Now, if you are new to the market, you have to develop a trading style. You cannot just be simply gambling in the market. You have to make a disciplined trading style. Unlike traditional share markets, CFD traders can find opportunities in both rising and falling market. Traditional share market, how was it? You can either buy and then sell at a high point or buy and keep hold of it because the market is going down. Your portfolio will be down. CFD, what happens if you take a sell, the market is going down, you get a profit. You don't need to wait for it to come back up to get profit. Okay. Leverage option for less capital requirement. If you don't have much capital, okay, this is the main concern with most of the people all around the world. Since they cannot put in much capital, you can put less capital as well and trade on leverage. Leverage is very difficult to trade on because it can either make you rich in one day or it can either make you poor. So please choose it wisely. Again, like I said, Forex is not new. It has been happening for a very long time now. It's the oldest form of market, originated from barter system. Okay. And modern currency is commonly referred as fiat currency. Fiat. Fiat means regulated by the government. It was previously reserved for wealthy individuals only. Only multimillionaires, billionaires could trade on it due to lack of leverage. But since internet was publicized in mid 1990s, people saw the opportunity to earn online. And that is when Forex had a global market surge. People came to know about Forex. They were like, okay, we can trade and we can earn money online. We don't need to go anywhere outside. Today, it is so easy to open an account directly that you can just open an account and start trading within few minutes or seconds. Okay. Now I'm going to explain the basic terminology which the market has. Bid price is the price you can sell at. Okay. Ask price is the price you can buy at. Okay. Bidding and selling, bidding and asking is this thing. Liquidity means the ease of buying and selling the instrument. If there is high liquidity, that means there is good ease of buying and selling. If there is no liquidity, that means there is no ease of buying and selling. You have to wait. When you're talking long, long means buying a currency, short means selling a currency. PIP, price in point. PIP means there is, if you try to calculate the spread, let's say the market went from, gold market went from 2,500 to 2,400. How many pips of difference was there? 100 pips. That's the meaning of pip, the difference. So when you're checking the currency pair, okay, AUD, USD, AUD is the base currency. You will buy or sell AUD based on US dollar. Okay. So let's say bidding price is 0.8937, which is the selling price. If you're checking the asking price, which is the buying price, 0.8939. Okay. If AUD USD price is 0.8939 plus it will have 10 pips. So what will be the price now? 0.8949. In Forex currencies is different. Sometimes you'll be able to see 1 point something. The other times you'll be able to see maybe 2480, like gold, 2500 right now. Movement of 100 pips is equals to 1 cent. Price will change to 0.9039 from this if there is a 100 pip change. Okay. Now, this is a very important topic, guys. This is what everyone should know how to use. Because if ever you are trading with a broker, this is the main thing people lose or gain money in. Okay. So, leverage, what it does is it amplifies the potential gains and losses. Means, let's say you have a leverage of 5 is to 1. If you are gaining anything with minimum capital, you will be gaining into 5x. If you are losing it, you are losing 5x. So that means it can either make you rich in one day or very poor in one day. It can eat up your capital. So that is why you need to be very careful about using leverage. A very useful tool for traders lacking capital to make significant gains in the market. What leverage does is it allows everyone to access the currency market. It's not like only rich people can trade. These people can trade as well. Smart FX, the company I work for, we offer leverage up to 400 is to 1. You don't need to be very much into leverage as a beginner. Okay. I would suggest take it easy. Do not use leverage. Let's look how leverage works. With 400 is to 1 leverage, to open a position of this much dollars, this many dollars, you will only need 2,500. Okay, why? We'll explain it. We call this 2500 margin required. Means to open a position this big, you will need this much. This will be set aside from your capital. So to open a position this big, you will need a capital more than 2500. For example, $5,000. If you have a big amount of capital, okay, let's say 5,000, $10,000, you will not put it completely in the market. You will be putting a set of like a minimum amount towards the trade. Required capital to open this much is $2,500. If you're taking 400 is to 1. Okay. So while leverage amplifies gain, it also amplifies losses. So be careful about it. How do we know when to buy or sell? In the market, there are multiple opportunities every day to buy or sell. How do you know that? There's technical analysis. Technical means you're looking at the chart, you're using different indicators, you're looking at different indicators like RSI, Bollinger Bands, moving average, Fibonacci. There's a lot of technical indicators which you're using. Then you're checking the candle, bullish candle, bearish candle, fair value gap, character change. There's a lot of things. Then comes fundamental analysis. When you're checking fundamental, you are checking what is happening with the currency and the country. If the country is doing well, currency's price will rise, which in turn tells you to buy or sell the other currency. If the country is failing, it is not being up to the mark, then that means the currency's value will be lowered and the opposite currency will rise. Okay. Then comes sentiment. Sentiment is basically you're looking all around the world what is happening. For example, there is a war going on right now. So that means commodities price will be on a high. They will keep going high until and unless the war stops. They will have a few setbacks, but then again, this is very important to know what is happening all around the world. When you're understanding global information, you can let's take an example. Okay, there's a war going on between Ukraine and Russia. Russia is a major export of energy, major country of export of energy. Global leaders, what they do is they place economic embargoes on Russia, means people cannot export or import from Russia. Let's say we speculate the war continues, oil prices will go up because of supply disruptions. When there is so much demand of something, but there is very little supply, what will happen? The price of that commodity will rise. So XTI and XBR quoted against USD. We do this buy XTI USD or XBR USD. We will buy them both because we know that the price of this commodity will rise since Russia cannot export anymore. Supply anymore is not happening. That means the price will rise. Let's understand this with currency. Instead of commodity like oil, we'll understand this with currency. US is aggressively hiking up interest rates due to high inflation. When inflation is rising, what the country does to prevent hyperinflation, they hike up the interest rate. Eurozone is not as aggressive in hiking rates. Eurozone is hiking rate, but still not as aggressive as US. Bank of Japan is not even considering hiking any interest rate soon. So that means US is the top one, making the interest rate go very high. Eurozone, not too much, a bit high, but not too much. Bank of Japan is not even considering. So let's say the inflation in US keeps going up. FOMC will hike aggressively. ECB and BOJ will not aggressively hike due to economic reasons. So at this time, what do we do for these currencies? At USD JPY, you will be buying. Why again? I'll share it to you. When JPY is not increasing any hike rate, we expect US dollar to be valued higher than JPY. Why? Because they are rising the interest rate. When a country rises its interest rate, the value of currency will go up. Okay. So over here in USD JPY, you will be buying US dollar compared to JPY. When you are checking Euro USD, where USD is the counter currency, we expect USD to be valued higher than Euro. If USD goes up, Euro goes down. So what are you going to do at that point? Sell Euro USD because you are expecting Euro to go down and USD to become stronger. Major pairs in Forex currencies are Euro, GBP, Australian dollar, Japanese yen, Swiss franc, Canadian dollar, New Zealand dollar. These are the major currencies traded. Some of them are very highly liquid and some of them have non-exaggerated volatility price movement. Okay. Volatility refers to price moving very aggressively here and there, up and down very aggressively. That is called volatility. Because of this, they usually have lower spread. When there is high liquidity and there's not much volatility moving here and there very quickly, that's when the spread is lower. When you check out minor currencies that are cross currencies, these currencies exclude US dollar. They do not have US dollar in them. For example, Euro JPY, AUD JPY, CHF JPY. These currencies do not include US dollar. What happens in them is that because they are not commonly traded, they have very high spread. Okay, buying and selling price is very high, which means it is lacking in volatility like Euro GBP and some with high volatility like GBP JPY. GBP JPY on the other hand has a lot of volatility, but Euro GBP has no volatility as well as much as this. Okay. Then comes exotic pairs. Exotic pairs is very interesting to look at because you are associating yourself with different countries which are developing. For example, if you see some currencies like Turkish lira, Turkey is developing country, Thai baht, Thailand is another, Malaysian ringgit, Indian rupees. These countries are slowly developing. So what will happen is that the price of their currency, the value of their currency will go higher. Exotic currencies are not commonly traded because they lack liquidity, causing them to have a higher spread. Spread is the difference between buying and selling price. People do not trade in currencies which have high spread because they do not want to end up in a big loss. When there is a high spread, spread is mainly charged by the broker. So that is why you don't want to trade with a higher spread. Movement on these pairs is exaggerated, means there is a lot of volatility because it is controlled by the governments. So if the government wants the value to go up, they'll just pump it, dump it. That's what they do. These pairs are usually harder to analyze because the range carries a higher risk than major or cross currencies. So if you're looking that the government controls these currencies, you cannot really analyze them because there's no particular prediction. Even if you read the chart, even if you check fundamental analysis, it all depends on the government, what they want to do. Okay. So hopefully you guys have learned something from this webinar. And if you want to start directly with us, you can message me or you can sign up on this link. That's it from me, guys. And I hope you have some value you have learned from this webinar. If you want to message me, you can message me on my number, which I had given. And hopefully we start our journey together. Thank you so much. Have a good day. Bye bye.